Hello, my CFA friends. How are you, my friends? Today, we begin our equity journey. Our equity journey, my friends. So, market organization and structure is the first reading here. We're going to be talking about margin trading. We're going to be talking about leverage position, margin calls. And we are going to look at the limit order book and different types of orders that you can place with the broker. So pretty exciting and pretty interesting stuff. Let's get started. Okay, my career changes. I know I always have some career changes watching this video, so these words may come as a little bit of a surprise. Nothing to do with distances here. It's not long or short in the literal sense, but these are terms that we're going to use, of course, when we trade. And long either simply means that you are buying the security, or in the futures market, in the derivatives market, this would mean that you are promising to buy the security at a fixed price in the future, the underlying, as we like to call it. And why would you be doing this? Well, probably you believe that the asset will appreciate. And again, that is nothing to do with the zoo or with your farm, bulls, bears, animals like that. Nothing to do with that, hawks and doves. But in this case, if you believe that the asset is going to appreciate, you are bullish on the asset. So you're confident about the future of this asset. And of course, if you're promising to buy at a fixed price, there is no limit to how high the price can go. Sky's the limit, really, here. So you've got unlimited gain potential on a long position. So imagine, buying, let's say, Bitcoin when it was under $1. Yeah, and now it is much higher than $1, as you know. So you really have unlimited gain potential when you have a long position. Now, short means that either we are selling the asset right now, okay, I'm shorting the asset, or I am promising to sell the asset at a future date. So that would be more relevant to derivatives. When we short a forward, we would be promising to sell at a future date. Here, of course, I'm doing this because I want to lock in the sale price today. Essentially, I think the asset is overpriced, so I want to sell it at a high price, and I'm hoping the asset will decline in value in the future. I'll be able to buy it back, cover my short position, and make profit. So in this case, I am a bear, or I'm bearish on this asset. I am not confident about the future of this asset. And in this case, actually, I've got unlimited loss, because when you short an asset, you are locking in the sale price. But remember, there is no upper limit to how high that asset can go. So if it does appreciate, that price movement is against you. And at a future date, you will have to cover your short position by buying back that asset more expensively. And again, here, just think about, shorting the market when the market is rallying. That's probably a pretty easy way to get wrecked, right? So you don't want to short the market when the market is going up. You want to trade with the trend. The trend is your friend, as they say, until the trend reverses. And also here, there are some idiosyncrasies. The short seller, so it's you're not just the seller. Short seller will typically borrow the security from the owner of the security, which will be known as the lender, the security lender. So we're going to borrow that security, and then we're going to sell it in the market. And there will be an agreement between the short seller and the security lender that any dividends paid during the time this trade is open will be owed from the short seller to the security lender. So any dividend payments will have to be paid to the security lender. We want to also go over the lingo here before we get into the computations. So we've got some lingo associated with leverage positions. So positions where I'm going to use borrowed funds in order to trade. So the first concept I want you to understand is the concept of initial margin. So think of margin as your equity in the trade. So initial margin is your initial equity or initial deposit in order to open the trade. Then comes maintenance margin. Now, maintenance margin, I want you to think of it as the minimum acceptable level of equity that is allowed on your trading account before the broker gets upset and decides to want to close your position. Okay, because effectively, because you're using leverage here, if the market moves against you and you're not fully collateralized, you've only put a portion of the value of the position in the trade, obviously that exposes your broker to the risk of you defaulting. So the broker is going to want to close your position at some point before your equity runs down to zero. Okay, and that's going to be known as the maintenance margins. It's the minimum equity as a percentage of the stock price that you should keep in your account in order to avoid your account being closed or your position being liquidated. And if you do not essentially top up your account before that happens, if you do breach your maintenance margin, you're gonna get the dreaded margin call, my friends, which isn't actually a call. It's more like an email, probably. So yeah, don't imagine like this formal call from the exchange. It's probably an email saying, look, come top up your account because otherwise we're gonna liquidate your position. And we're essentially going to close your position, and you're not going to be able to benefit from any appreciation in the value of the position subsequent to that. Then you've got the call money rate. So that's just the interest rate on the money they're lending you. So the initial margin is your equity. Say you put 40% down, so they must have lent you 60%. That's the loan amount. And then the call money rate is the interest rate on that loan amount. And then the leverage ratio is simply defined actually here. Let's look at how it's defined. It's defined as 1 over initial margin. So as an example, if my initial margin was 50%, 1 over 50% will give me 2x. And that would imply that for every 1% change in the value of the position, I'm going to gain either 2% or lose 2%. So 2x leverage means that my returns are 2x magnified with respect to the actual movement in the underlying asset. Let's look at an example with margin trading. So my investor purchases a stock for $100 using 25% initial margin. So he's going to be putting in 25 cents on the dollar, and the broker's going to be putting in the remaining 75%. The stock price at the end of the period is $110. What is the investor's required return what's the investor's return on equity? Okay, so let's look at the quick and dirty way of solving this. Well, my initial margin is 25%, as we have seen here. So my leverage multiple, my leverage ratio, if you like, is 1 over the initial margin, which is 1 over 25, which is 4x. Okay, so now I know that every time the stock moves by 1%, my position is going to move by 4%. I'm 4x levered. Okay, well, let's calculate the holding period return on this stock. So the stock appreciated to 110. Remember, the formula is P1 over P0 minus 1. So the stock appreciated to 110 from 100 minus 1. That's just going to give me 10%. So the underlying stock appreciated by 10%. So my return on equity in terms of my leverage multiple here is 10% return on the underlying stock times 4x leverage gives me 40% return. It's a pretty healthy return if you ask me. Now, was there a different way to solve this problem? Let's have a look at the alternative way to solve the problem. The alternative way is to realize that your equity is 25% of 100, which is $25. And here you know that you've made $10, so the appreciation is from 100 to 110, so your return on equity can be calculated as the $10 profit, the appreciation from 100 to 110, divided by your equity of $25, and that, of course, is also 40%. Next, we're going to look at an example of how we're going to calculate here the return on a leverage position when we are given a lot more information. So here we have to calculate the return on equity for the following position held for 1 year. We're going to assume that interest and dividend are both paid at the end of the year. So I've got purchase price $30, sales price $36. So already here I can see that I can make 20% on the underlying asset with no leverage. Number of shares 500, that's how many shares I'm buying. Initial margin is 40%, I'm putting 40 cents on the dollar down. Broker's putting the remaining 60. Call money rate is 4%, so that's the interest rate the broker's charging me on the 60% loan. Dividend per share is 8 cents. And I've got also a two-way commission per share of 2 cents. Two-way just means that you are paying that commission when you buy, but also when you sell at the end of the period. Okay, let's get started. Of course, if you feel brave enough, pause the video and give it a quick try yourselves before revealing the solutions. So the position will be $30 times 500 shares, and that, of course, is $15,000. From that $15,000, we're going to have equity, which is 40% of $15,000. And that, of course, is $6,000. The loan can either be calculated as 60% of $15,000, or you could simply say, well, the position is $15,000. I had to put $6,000. So the broker had to put the remaining $9,000. Okay, what's next? We know that the call money rate is 4%, so that's the interest rate for 1 year. So my interest expense is going to be 4% of $9,000, which of course we know is $360. What else we've got here? We've got dividend per share. So the div is going to be spot 08 times 500 shares. 5 times 8 is 40. So we got $40 of dividend. And then I've got also a commission. Now, don't forget, that's a two-way commission. So we're going to pay it at the time of purchase, but also at the time of sale. So that's spot 02 times 500. That's $10. Okay, and now we are ready to perform the HPR computation. Okay, remember, keep it simple. HPR computation is simply P1 over P0 minus 1. And P0 is, of course, our equity at the start, how much we've invested. And P1 is what we are actually gonna get back when we sell. Okay, so P0, initial equity, P1 is what we're going to get back. So HBR then. Let's think about the numerator here. It's going to be quite a few things. Well, firstly, we're going to sell the stock at 36, and it's still 500 shares that we are selling here. So we can go ahead and calculate what that's going to give us in a minute. But that's the future pot that our shares are worth. Now, we're going to have to repay the loan. Remember, you borrowed $9,000, so repay your loan. There you go, $9,000 is the loan. We are going to have to pay the interest on the loan. Okay? But dividends represent money coming into our account, so we are going to add $40 a dividend. And commission on the sale represents money leaving our account, so we're going to subtract that commission up here. Now, for the denominator, I need to have my equity, so I had 40% of 15,000. That's $6,000 of equity. But be careful here. When you entered the position, you also had to pay the commission. So that was an additional outlay of $10 at the time you purchased the shares. So we're going to be adding that to the denominator as the commission on the purchase. And of course, HBR formula should have a -1 here. So go ahead and check what that gives you. And my friends, I'm getting 44.26. So let's write that down here, 44.26%, which is our accurate calculation. Now, Alpha Bravo Charlie, it's a multiple choice exam, as you know. So you're going to be given 3 options. If the options are very well spaced out, you can probably take the quick and dirty approach. I love the quick and dirty approach. So the quick and dirty approach is to say, well, the stock has gone up by 20%. You can see that very, very quickly here. You can also say that your initial margin is 40%, so that your leverage multiplier here is 1/40. Which is, as you know, 2.5x. So your HPR, your holding period return, should be approximately 20% times 2.5x, which is approximately 50%, right? Which is approximately 50%. Now, I know it's not going to be exactly 50% because of the interest rate, the dividend, the commissions, but at least Alpha Bravo Charlie, we can have a look at the 3 options and see which one is closest to 50%. Next, we are going to determine the margin call price at which, obviously, our trader gets the dreaded margin call. Okay, so a trader buys a stock for $30 on initial margin of 40%. The maintenance margin is set at 25%. Below what price will a margin call occur? Now, if you're a formula lover, if you want the quickest way to actually getting the right answer, I'm going to give you a formula. So you're going to take the share price, you're going to subtract 1 minus the initial margin, you're going to divide by 1 minus the maintenance margin, okay? And this will be essentially the share price at which you get the margin call price. Okay, what should we call that? Margin call price. Okay, so our share price is $30. Our initial margin is 40. Our maintenance margin is 25. And if you do this on your calculator, you're going to get that price, which is $24. So that's probably the quickest way to obtain the price at which you're going to get the margin call. However, if you're not much of a formula lover, if you're not someone who necessarily likes to memorize formulae, if you like to intuit the answer, you can also do it without knowing the formula, albeit at the cost of having to do a little bit of algebra. Okay, so let's do it with a little bit of algebra. So can you see here that if we are putting 40% down, then they are lending me 60%. So the loan amount must be 60% of $30, which is $18. So they're lending me $18. So right now at the start, my equity is $12. Okay. Now let me see what I need to do here. Let X be the share price. So let's just use X as our share price. So at any point in time, my equity, my current equity at any point in time is simply the share price minus whatever they lent me, which was $18. And if I divide that by the share price, it should give me my percentage equity as a percentage of the current share price. And I don't want that to fall under spot 25. Okay, so that's really the equation that I'm rearranging. So I can, first of all, move the X to the other side and get 0.25X. I can then move the 18 to the right and the bit with the X to the left. So I'm going to get X minus 0.25X equals 18. Of course, 1X minus 0.25X is 0.75X equals 18. So therefore, now I can work out X as 18 divided 0.75, which I'm guessing is going to still give me $24. Okay, but let's also check that it is at this point that we are getting a equity as a percentage of stock price of exactly 25%. So let's check that as well. Okay, let's change the color here because it's getting a little bit cluttered. Now, if my share price is right now $24, how much is my equity? Okay, so my equity is going to be $24 minus $18 that they lent me, right? So that number's not changing. That's how much they lent me. So my equity is $6, my friends. Okay, my equity is $6. So what is my percentage equity at this point? Well, my percentage equity must be my dollar equity over the current share price, which is 24. Okay, but we know that this is also equal to 1/4, and we know that 1/4 is equal to 25%. So we've demonstrated that the price at which we're going to get the margin call is indeed $24, because when we hit $24, we would have exactly 25% equity, and the maintenance margin is set at 25, so a margin call will be issued. Support my channel and sign up to the question-based revision for an unbeatably low monthly price. Just go to stoianov.co.uk/revision. There are no contracts and you can cancel anytime. The link is in the description. And while you're here, smash the like button. Next, we are going to continue with the limit order book. So here's an example of a limit order book. Of course, from previous readings, you know what bid and ask are. Bid, of course, means the price at which we are willing to buy, and ask is the price at which we are willing to sell. So in our case here, we have someone willing to purchase 40 units at $10.10, then 20 units at $10.20, and then another order here, 30 units, willing to buy 30 units at 10.4. So notice here that we are arranging them in ascending order. So this order here is the highest bid. Okay, so this is the highest bid. Somebody is willing to purchase 30 units at 10.4. So this is the bid size of our book. Down here is the ask size. So let's start at the bottom. So there's 13 units. Someone is willing to sell 13 units at 10.8. Someone else is willing to sell 5 units at 10.7. And the most aggressive offer is 10 units at 10.5. So notice here that this is the market, okay? So this is the most aggressive bid. Yeah, 30 units at 10.4 is the most aggressive bid. The most aggressive ask is 10 units at 10.5. And this, in fact, here is our bid-ask spread, 10.4 to 10.5. This is known as the market, my friends. So if we are referring to a situation where we are at the market, we're either placing a bid at 10.4 or we are placing an ask at 10.5. That's the market. Now, behind the market, who is behind the market? Well, these guys here, the 40 units at 10.1 and the 20 units at 10.2 are behind the bid, so they're behind the market. Just like these guys here, down here, they are behind the ask or the offer, so they're also behind the market. They're less aggressive. They're only going to get executed if the market moves. And then we've got inside the market. Inside the market would be the area between 10.4, let's call that CN, 10.4 and 10.5. That is, of course, the market. And anything in between will be inside the market. So if someone now comes with a price of 10.42, let's say, he'll be placing a bid inside the market. Okay, we also need to distinguish between being a maker and being a taker. So let's say I want to sell some shares, right? So remember that these bid orders are people willing to buy. So if I want to sell, I need to trade with these guys. So if I want to sell, let's say 10 units, I'm going to be able to sell them at 10.4 because they're actually 30 units which are willing to buy at 10.4. So if I wanted to sell 10 units, I will be able to sell them at 10.4. So remember, when you're trading with the book, you're always selling at the bid and buying at the ask, right? So if someone comes and wants to buy, he again will be a taker if he buys at 10.5 because he takes the market. He trades at the market. He trades at the most aggressive ask if he is buying, or at the most aggressive bid if he's selling. That's a taker, my friends. That's a taker. What is a maker? So you can either make a market or make a new market. When you're making a market, you're simply adding to the limit order book. So if I wanted to, let's say, buy at 10.4, right? So notice here that I can't buy at 10.4 because this guy wants to sell at 10.5. So I cannot take the market. Yeah, he wants to sell at 10.5. Nobody wants to sell at 10.4 right now. So if I want to buy at 10.4, I will be making the market. I will be providing liquidity to the market, and my order will be added to this bid line. So if I wanted to buy 5 units at 10.4, the limit order book will be updated, and it will now say 35 units at 10.4. That's what it means to be making the market. You're providing liquidity. If you want to make a new market, for example, I want to buy 5 units, but I want to be even more aggressive than these guys. I want to be ranked ahead of these guys, I could say, well, I want to buy 5 units at 10.42. And of course, in the limit order book, I will appear at the front because my bid will be the most aggressive bid. Now, a little piece of knowledge here, if I may. This is not required by your exam, but of course I trade, so just to give you a little bit of my experience with most exchanges. Be careful. Maker fees and taker fees are different. When you are a taker, you are mopping up liquidity because you are trading at either the best bid or the best ask. Okay, so you are taking liquidity. When you are a maker, you are providing liquidity. You are placing a limit order. So the exchange likes that, okay? The exchange likes when you are a maker, and therefore the fees, the actual trading fees that you pay for being a maker are likely to be lower than the fees that you pay for being a taker, right? So that's purely talking about commissions. Unfortunately, there is a disadvantage. If you are a taker, your trade will execute immediately because it's going to be essentially a market order. And if you don't know what the difference between limit order and market order is, stay tuned. We will cover that today. But if you're a taker, your order is instantaneous. If you're a maker, you're simply adding liquidity to the book without a guarantee as to when or even if your order will execute. So unfortunately, if you're a maker, the market may move against you and you may not be able to execute your trade, or you may execute it with delay. Okay, let's have a look here at a limit order example. Our trader submits a limit order to buy 20 shares at 10.7. What happens to the book? First question. And what is the average purchase price? Okay, so our trader wants to buy 20 shares at 10.7. So he's actually buying, therefore he's trading with all these guys down here, the ask people, the ones who are willing to sell. So let's think about, first of all, what happens to the book. Well, he wants to buy 20 shares and he wants to buy them at a price no higher than 10.7. So that's essentially your limit order. You do not want to exceed 10.7 as a purchase price. So you want to buy cheaper, perhaps, or at that price, but not more expensive. So this 10 units at 10.5 are a great deal. So they get all bought up because they are under 10.7. There are no deals at 10.6, so we skip that. And then we get to 10.7, and there are 5 shares selling at 10.7. Now, remember, the guy wants 20 and he's bought 10 already, so he's going to end up buying 5 additional shares at 10.7. So that's going to go away as well. But the problem now is that the next price is 10.8, and he has placed a limit order, saying, okay, I don't want to exceed a purchase price of 10.7. And that's a problem here because he is not able to purchase all his shares. So he's bought 10 shares at 10.5, another 5 shares at 10.7, but he has still 5 shares that he hasn't bought. So those 5 shares, my friends, will be added to the limit order book. So here in the bid size, I'm going to have, let's say I'm going to have an additional bid that will say, okay, I've got 5 shares. I'm willing to buy 5 shares at 10.7. And that will be added essentially just under the 30 shares. And yeah, in that case, he will be making the market and he'll be waiting for someone to become willing to sell at that price. So that's the first question. The second question is, what is the average purchase price? What is the average purchase price? So let's have a look. So he bought 10 shares at 10.5, and then he bought 5 shares at 10.7 for a total of 15 shares. And the answer here is $10.57. And as you can see here, that is actually less than 10.7 because he was able to snap up some good deals under 10.7. But unfortunately, he wasn't able to execute his entire trade. Okay, next I want to look at the types of orders that you've got in the market. So, market order is an order that allows me to execute at the best available price. Okay, so just give me whatever the best available price is. Remember, brokers have a fiduciary duty to execute trades on behalf of their clients at the best possible price at that moment in the market. Now, a limit order, we saw the limit order book. These were people who were willing to either buy or sell at a price that was either lower or higher compared to the current market price. So, for example, if the asset's trading at 20, a limit buy could be set at 17. In other words, what I'm saying is, look, 20 is a bit too expensive for me, so I'm going to wait until the asset drops to 17, at which point my limit order will become a market order. It will execute. Likewise, if the asset was trading at 20 and I held the asset, but I thought, you know what, I don't want to sell that asset until it hits 25, I could set my limit sell order at 25. So just to summarize here, market order executes immediately at the current bid-ask spread. Limit buy is set below the current market price. Limit sell is set above the current market price. Then I've got stop losses. Guys, this is, I've done a bit of trading, and one of the most valuable and also expensive lessons that I've learned, because I wasn't doing it, expensive because I wasn't doing it, was not using stop loss or orders. So always, when you've got an open position, make sure you've got a stop loss so you know exactly what your exposure looks like. Okay, so a stop loss could be a stop loss sell order, which you would typically set on a long position. If you already own the asset at $20, but you're worried about let's say a drop in the value of the asset of more than $3, then you could set a stop sell order at 17, which means that if the asset now drops down to 17, that stop sell will become a market order and it will attempt to get rid of your position. I say attempt because there's always slippage. Sometimes market moves very, very quickly and you may not be able to get that price. Secondly, you've got stop buy. Now, stop buy is the opposite of stop sell. You'd be setting it above the current market price. You typically do that if either you have opened a short position to start with, or some technical traders use it on a breakout of resistance levels. Then you've got GTC. GTC stands for good till canceled. So essentially, it's an order that does not have expiry. So you open it and it just stays open on your account until you cancel it. You've got IOC or FOK. IOC stands for immediate or cancel, or fill or kill. So these are kind of synonymous terms, immediate or cancel, or fill or kill. As the name suggests it, this order will only execute if it can trade with what's available in the limit order book straight away. If not, it's not going to add to the limit order book. It will simply cancel the order. So it will either trade at whatever price you're giving it, or it's going to cancel the order. And then the day order, which is a very, very common type of order, is an order that will stay open for the duration of the trading day, but it will be canceled at the end of the day. And we're going to finish with a few more definitions here, just to make sure that you're fully covered for this reading. Broker versus dealer. So I already mentioned that a broker is someone who trades on behalf of actually executes trades for their clients. So they have the duty of executing the trades at the best available price, whereas a dealer is someone who will trade directly with you. So they'll be buying low from you and then turning around and perhaps selling higher to another counterparty or another client. So they're not going to necessarily, provide you the best available price as the broker will. And in a lot of cases, the distinction is blurred. So you're going to have broker dealers. So if you think about your big investment banks, they could provide you brokerage services, but they can also trade for their own account as a dealer. Then I've got the IPO versus the season offer. IPO, of course, is initial public offer. So the investment bank here is helping clients raise equity capital for the first time, become a publicly traded entity. But once you're a publicly traded entity, should you wish to raise further equity capital, that additional offer is known as a seasoned offer. Then I've got the primary versus secondary markets. Primary markets is where companies issue equity and debt capital for the first time, whereas secondary markets is where that existing equity and debt capital is traded among investors. Coal versus continuous markets. Well, coal market meets once a day when the market gets cold, and that's when all the trades are happening at that specific point in the day, whereas a continuous market, as the name suggests, it will trade continuously throughout the day. Lastly, we've got quote-driven versus order-driven market. So that example that we were looking at earlier with the limit order book, that was an example of order-driven market because we ranked the orders. We had the most aggressive bid meet the most aggressive ask, meaning the highest bid met the lowest ask, and that's how trading happened based on obviously the aggressiveness of the prices, the time of arrival of the various orders. That's an order-driven market. A quote-driven market is a dealer market. This is a market where we trade not with ourselves, but we're trading with large dealers, with large providers of liquidity. So we're actually going to be trading at the quotes that they are providing to us. And that's why we call that quote-driven market. Okay, that's all I wanted to say in this reading. I hope it was helpful, but I'll definitely be seeing you in a lot of other equity readings. Until then, have a great day.